Hello, I'm Monica Gibson and you're watching Dukascopy TV and another exclusive interview. Today I'm joined in the studio by Pierre Mouton from Notz Stucki. Pierre, thank you very much for coming in today.
You're welcome.
Now
Good morning.
Good morning. Now we're going to be looking at the secret to a successful portfolio. Now, given the fact that we have all this unprecedented monetary stimulus being injected from central banks and the different kind of economic hurdles that we're having to climb over, shall we say, how is this affecting the evolution of the portfolio management, would you say?
Well, it is true that we have unprecedented fiscal stimulus from monetary stimulus and fiscal stimulus to a certain extent from central banks and governments. But this is not new. I mean, it has started since 1997, 1998 with Alan Greenspan. And we see that in portfolio management, these injections of liquidities tend to create bubbles. So you have, if you're good, you have to try to take profit of the bubbles and get rid of the assets before the bubble collapse. And it has been the case in technology, it has been the case in US housing market, commodities, gold, possibly interest rates, we don't know. So it is extremely difficult to navigate in this environment because, I mean, we know when bubbles are forming, we don't know when they burst. So you have to be eclectic and cautious.
That is the danger. But in terms of particular types of funds, could you maybe tell us some which have been or proved successful for Notz Stucki?
Well, in the global asset allocation of portfolio, I mean, you have different objectives depending on the funds you buy. I mean, if you buy a fixed income funds, you probably tend to have some kind of protection. And when you buy equity, aggressive equity funds, probably you tend to look for capital gains. The last year was extremely good because we had fixed income, corporate bonds, equities, hedge funds doing very well. And this year it's quite different, and during the downturn of April, May and June last year, we saw that when equities went down, it was very good to have these fixed income funds that were doing well, so mitigating the losses that you had on the equities. And this is not the case this year, so you have to be once again very, very careful when building a portfolio, not just looking at the past performances to build the portfolio, and more look what is the client looking for, and then build the portfolio accordingly.
I've seen what's on the horizon and adjusting, as you say. But in terms of discretionary mandates with Notz Stucki, the objective of the discretionary portfolio is to generate risk-adjusted return by investing in a diversified portfolio. I understand this from your philosophy and your policies, but could you tell us a little bit about this and how you advise clients or how you advise investors accordingly?
Okay, so exactly, the objective is generating a risk-adjusted performance for the clients, once again depending on their risk aversion or risk-prone attitude. And you have on the next slide here the performance of a balanced portfolio that we managed at Notz Stucki since 2005, something like this. And you will see that it corresponds exactly to what we look for. I mean, generating good performance with lower risk than the market, and what is extremely important once again is to avoid the big losses like in 2008. So even though the portfolio was down in 2008, we're still on a high watermark basis. So we advise our clients to make sure that their investment profile corresponds to what they expect. If you are conservative, don't expect to do 100% of the equity market performance, and if you are aggressive, don't expect to be positive when all equity markets are down.
Now, looking at gold in particular, it's often or was often deemed as a good diversifier. Given the sort of volatility that we've seen, and it's just suffered its largest quarterly drop, has this impacted the way that you're positioning your portfolios, would you say?
Okay, so well, I think it's a misunderstanding that gold is a diversifier, because when you look in historical terms, I mean, the beta of gold to markets is almost zero. So there is no correlation between gold and markets, either they are up or down. What is very important is to understand that gold thrives when you have inflation or deflation, or inflation fears or deflation fears. Exactly what happened during the last decade. I mean, we had more and more deflationary pressures that are still in place, but far less now. And it's the reason why gold has performed so well during the 2007, 2008, 2009 and 2010 period, because we had very, very high deflationary threats and deflationary fears that has been confirmed by central banks' actions, by the way. But now that these deflationary pressures are abating a little bit, or at least investors are less afraid of deflation, probably that explains the very bad performance from gold recently. We at Notz Stucki decided to remove gold from the balanced and aggressive portfolio in the second part of last year, and we got rid of gold for the conservative accounts at the beginning of this year, because we saw that central bank actions were really removing these huge deflationary threats that we had on global economies.
That's very interesting. But in terms of different, the performances of different classes, equities, for example, have been outperforming most other classes. Hedge funds having a bit of a torrid time of late. So with this all in mind, is it just as easy to have a balanced portfolio? Does the sort of initial shortfall or underperformance, can that be compensated longer term? How do you work it all out?
So once again, as we said earlier in the interview, last year was very, very special. I mean, we had all kinds of asset classes performing extremely well. I mean, hedge funds, equities, bonds, corporate bonds, government bonds, emerging market bonds. And this year it's quite different, because we've seen that in the recent downturn, we had equities going down, we had fixed income coming down, we had the emerging markets coming down, gold coming down, etc., etc. So with this recorrelation of the different asset classes, we think at Notz Stucki that it's very important to be invested in. Well, the asset class of choice is clearly equities today, because that's where you have value probably much more than any other asset class, and you also have to be invested in absolute return strategies that will not be correlated to gold or equities or fixed income. That's very important today, to have a good allocation to absolute return strategies, just because we don't know in the next wobbling of the market if recorrelation of all assets will work again or not. And in this case, it's good to have absolute return strategies that don't have any kind of correlation with the rest of the asset classes.
Perfect. Pierre, thank you very much for sharing your perspective and your tips there. I'm sure a lot of good ones for our audience. That does bring us on to our Dukascopy question we would like to ask you just before you run away. The Dukascopy question is, if you had $1 million to invest for 1 year.
I would love to.
Yes, please. Which asset class would you choose to invest in? We have some options. We have real estate, equity, bonds, gold, cash, and indeed oil. But where would you choose to place the money?
Well, first and foremost, and you won't be surprised when I reply, is the asset class of choice once again is for me equities.
Equities, okay. Any particular reason?
Well, the reason is, compared with other asset classes, equities are really cheap. I mean, by any standard, you can look at the P's are normal, and compared to fixed income, to commodities, to real estate in some places in the world, equities are probably the best place to be if you choose the right equities. So we would tend, as of today, to be more in developed market equities than the rest of the world. But, I mean, this can evolve, but for the time being, yes, developed market equities, Europe, US, Japan.
Pierre, thank you so much for coming and sharing your perspectives and your time today. It has been a pleasure having you in the studio.
Thanks to you.
Thank you. Well, that's all from Pierre and myself for the moment. Click back to Dukascopy TV for today's press review and many more exclusive interviews. Goodbye for now.